Welcome to the Deep Dive. We're here to cut through the clutter, find the core insights from important sources, and make sure you walk away really understanding the topic.
That's the goal.
And today, we're tackling something that hits everyone's wallet, inflation. Specifically, how this sort of silent force really chips away at your equity investments, your stocks.
It's a crucial relationship to understand. We've got some great material guiding us today.
We do. Now, before we really get into the weeds, just a quick reminder. This deep dive draws heavily on material from Farhat lectures.
That's right.
All the content, the examples, the explanations we're discussing, they come from the comprehensive accounting resources over at farhatlectures.com.
It's a fantastic resource.
Definitely. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, you should check out the website. They've got extra practice questions, video lectures, lots of support to help reinforce what we talk about today.
And a big thank you to Professor Farhat for providing this material for our discussion.
Absolutely. Okay, so our mission for this deep dive is pretty straightforward. We want you to grasp the real, tangible ways rising inflation affects stock prices, the market overall.
Yeah, so you feel more informed, maybe a bit more prepared when you see those headlines.
Exactly, feeling prepared, not just worried. All right, let's unpack this then. We hear inflation constantly, right? News, work, everywhere. But what is it, fundamentally? Why does it matter so much for investors?
Well, at its simplest, inflation is just a general rise in the price level of pretty much everything goods, services.
Okay.
Think of it like this. Your money starts to lose its buying power. And that's the key consequence, especially here investing. It erodes, it reduces the purchasing power of every dollar you have.
So it's not just things getting pricier, it's the actual value of my cash shrinking.
Precisely. It becomes less valuable over time.
Can you give us an example, something concrete to show how that works?
Yeah, sure. The source material has a really clear one. Imagine you've got $100, and let's say coffee is $2 a cup.
Okay, 50 cups. Easy math.
Right. Now inflation hits. That same cup of coffee goes up to $3. Suddenly your $100, it only buys you around 33 cups.
Wow, okay. That's a big difference.
It really is. Same $100, way less coffee. That's the loss of purchasing power right there, in action. And it means your savings, your future earnings, they effectively buy less in the real world.
That really drives it home. Even small inflation adds up. And this erosion, this sort of hidden tax on money, that applies directly to investments too, right? Especially the equities we're focusing on.
Absolutely. It's not just about your daily spending. It impacts what your investments will actually be worth to you down the road.
Makes sense.
And just briefly, it's worth mentioning everything we're saying about rising inflation. Well, the opposite generally holds true if inflation is falling or if we see deflation.
Good point. But today, it's all about the upward pressure. Okay, so let's get into maybe the most direct hit. How inflation messes with asset valuations. This is where it gets really interesting, I think. It's not just vague economic anxiety, it's math.
Yeah.
Why do higher inflation numbers often mean lower stock prices?
Well, the main lever here is how central banks react. Think the Federal Reserve in the U.S.
Right, raising interest rates.
Exactly. When inflation gets too high, they typically raise interest rates to try and cool things down, slow spending. Now, interest rates. You can think of them as the basic cost of borrowing money.
For everyone, businesses included.
Yes, especially businesses. Higher rates mean it costs them more to borrow money for, say, expanding operations or even just managing their existing debt.
Okay.
That increases their expenses, which bites into their profitability. And lower profits naturally tend to lead to lower stock valuations.
So companies feel the pinch directly on their bottom line. What about investors? How does that rate hike impact our actual returns? So we hear about nominal versus real returns all the time.
That's such a critical distinction. Your nominal return is just the raw percentage gain, the number you see on paper. 10% return? Great.
That sounds good.
But the real return is what that 10% actually means after inflation takes its cut. So let's use the source example. You get that 10% nominal return. If inflation is running at 4%, your real return, your actual increase in purchasing power, is only 6%.
Okay, still positive.
But now, let's say inflation jumps to 6%. Your investment still shows that 10% nominal gain, but your real return has fallen sharply, down to just 4%.
Ouch. So a big chunk just vanished into thin air, effectively.
It's eaten away by rising prices.
Yeah.
And that makes the investment suddenly look a lot less attractive, even though the nominal number didn't change.
Yeah, I can see that. And I guess that makes other things, maybe safer things, look better, like bonds. If interest rates are up, don't newly issued bonds offer better yields.
Precisely. That's a key dynamic. When investors see they can get a higher, relatively safer return on new debt instruments, like government or corporate bonds,
Yeah.
well, why take the risk with stocks? So capital tends to flow out of equities and into these new, higher-yielding bonds. Less demand for stocks means...
Stock prices go down. It's a double whammy, like you said.
Exactly. Lower earnings potential and lower demand.
Okay, this is making sense. Can we make it even more concrete? Maybe walk through a valuation model, like the discounted cash flow thing, to show that direct math.
Absolutely. The DCF model is really useful here. It basically values a company based on the cash flow it's expected to generate in the future.
Right, bringing future money back to today's value.
Exactly. And the key factor is the discount rate you use to bring it back. That rate is heavily influenced by prevailing interest rates, which, as we said, are linked to inflation.
Got it.
So let's use a simple scenario from the source. Imagine a company, super stable, expected to generate $1,000 in cash flow every year, forever.
Okay, simple enough.
If the current interest rate, our discount rate, is 5%, you calculate the value. $1,000 divided by 0.05, that gives you $20,000.
20,000, okay.
Now here's the kicker. Inflation picks up. The central bank raises rates, and that interest rate, our discount rate, doubles to 10%.
Oh boy.
The company is still expected to make that same $1,000 a year. But now you divide $1,000 by point nanos, and the value is only $10,000.
Wow. Literally cut in half. Just like that.
Just by the change in the discount rate driven by inflation. It's not theory. It's the math of valuation. It shows how incredibly sensitive asset prices are to interest rate moves.
That's a really stark example.
Mm-hmm.
Does that same logic apply elsewhere, like bonds or real estate? Or is it just stocks?
No, it's fundamental. The same principle hits other assets, too. Think about existing bonds, ones people already own. If new bonds are issued at higher interest rates, the older bonds with lower fixed payments become less attractive, so their market price falls.
Makes sense. Why buy my old 3% bond when you can get a new one at 6%?
Exactly. And real estate, same idea. Future rental income, or the expected future selling price, gets discounted back to today's value using that higher interest rate. So the present value, the property's valuation today, goes down.
So higher rates generally mean lower values across the board for many assets.
Generally speaking, yes. It's a widespread effect.
Okay, so we've got the direct hit from interest rates and valuation math, but how else does inflation creep in and affect stocks? What about, just people spending money?
Yeah.
Consumer behavior.
Yes. This is the more indirect, but still hugely significant ripple effect. Remember our coffee example. Your $100 buys less.
Yeah.
When that happens across the whole economy, people just feel poorer, they have less purchasing power, and crucially, if prices are rising faster than people's wages, which often happens...
They're effectively getting a pay cut in real terms.
Exactly. They have less actual disposable income. And what do people do when money gets tight?
They cut back, usually on the stuff they don't absolutely need.
Right. Discretionary spending gets slashed. Non-essentials.
And that has to flow through to businesses, doesn't it? If I'm not buying extra coffees or new gadgets or taking trips.
It hits the revenues directly. Fewer sales means lower revenue and usually lower profits. The coffee shop sells less, the tech company sells fewer phones, the airline sells fewer tickets. It all leads back to lower corporate earnings.
And lower earnings almost always mean
lower stock prices. It's a pretty clear cause and effect chain, starting right there with the consumer feeling the pinch from inflation.
Is that pinch felt evenly everywhere, though? Or do some industries handle inflation better than others?
That's a really important point. Our source emphasizes that it's definitely not uniform. Different sectors react very differently.
Like who does well?
Well, sometimes sectors like commodities think oil, gas, metals, agriculture can actually benefit or at least hold up better.
Why is that?
Because their products are often essential. People still need to heat their homes or drive their cars even if prices go up. And these companies often have more power to pass on their own rising input costs to customers. Sometimes the price of their product itself is the inflation people are worried about.
Right, like rising energy prices.
Exactly. On the flip side, sectors like consumer discretionary, the non-essential stuff we talked about, fancy clothes, new electronics, travel, they often get hit hard.
Because that's the first thing people cut back on.
Typically, yes. Technology can also be sensitive, especially if it involves big purchases or upgrades that people might postpone. When your purchasing power is down, you prioritize. Necessities first, luxuries later.
So, as an investor, you really need to think about which part of the market you're in during inflationary times.
Absolutely. Understanding those sector differences is key because the performance can really diverge.
Okay, one last angle. What about just feelings? Investor psychology, market sentiment. How does inflation play into that more emotional side of the market?
Ah, the psychology. It's huge and often underestimated. Just the feeling that your money is buying less, that things are unstable, that can really impact confidence.
Uncertainty. Markets hate uncertainty.
They really do. If inflation feels like a major uncontrolled threat to the economy, it just breeds volatility. Investors get cautious, maybe even fearful. They hesitate to commit capital when the future feels so unclear.
That makes total sense. People get spooked.
Yeah, and there's another interesting dynamic the source mentions. Sometimes the expectation of future price rises makes people want to buy now before things get even more expensive.
Right, trying to beat the next price hike. Seems rational for one person.
It can seem rational individually, yeah. But if everyone does it, it can actually pour fuel on the fire, pushing prices up even faster in the short term.
Creating its own problem.
It can, yeah. And then eventually that buying rush slows down. Maybe companies are left with stuff they can't sell at the high prices, and you could see sharp drops later. So for all these reasons, the uncertainty, the fear, these weird buying dynamics, higher inflation generally, as the source puts it, doesn't bode well with equity. It just creates a tougher, choppier environment for stocks.
Okay, so wrapping this up, we've really covered a lot today, how inflation eats away at purchasing power.
How it pushes up interest rates, which directly lowers company valuations through that discount rate math.
How it squeezes consumers, leading to lower spending and corporate profits.
And how it impacts different sectors unevenly, plus that whole layer of investor psychology and uncertainty.
It really hits from multiple angles.
It does, and the core takeaway, really, is pretty simple. Generally speaking, higher inflation tends to mean tougher times for equity investments, lower valuations, more volatility.
It's a force you just can't ignore as an investor.
Definitely not. Understanding it is crucial.
You know, what's really interesting here, I think, is that just hearing about this stuff, gaining the knowledge, that's only the start. The real aha moment, that deeper understanding, comes when you actually apply it. Maybe you work through some practice problems on valuation, or you start analyzing companies differently based on their sector.
Or just make more informed decisions with your own money. Yeah, that's where the learning really sticks.
Exactly. This deep dive laid out the what's and the why behind inflation's impact. But exploring the how to apply it, that's the next step for everyone listening, to really make this knowledge work for you.